We want to be able to make sure we can understand a credit card statement. So here we have Teresa Torres's credit card statement. It has lots of good information on here. So let's start up here at the top. It gives the account number, the closing date for the statement. The next line tells us the credit line. Credit line is how much you can borrow on your credit card total. Okay, and then the next line is going to tell us the available credit. So she has $2,100 she could borrow total, but she has a balance. Let's look down here. Her balance is $523.20. So she's already accumulated that much debt. So she only can continue to borrow up to $1,576.80. So you got to be careful that if you're close to your credit line limit, that you don't continue to charge, because then you're going to have some penalties. Okay, so let's look down here. So our account summary, our previous balance, she had a balance of $1,686.15. She made a payment of $1,688.15, and she made payments of $523.20. And so her balance is $523.20. That doesn't seem to add up right, but let's just pretend it was right. So down here it says, okay, our balance is $523.20, and her scheduled minimum payment, so she has to make at least a $35 payment on that balance of $523.20. Okay, so if she just pays that $35, she doesn't pay off the whole thing, she's going to incur some expenses that she wouldn't if she did pay off that full balance. So she's going to have to pay interest. So let's look down here. So if she has a balance with purchases, she's going to have to pay an interest rate of 19.8%. Okay. If she used her credit card to just get some cash, the interest rate is higher for those. So that would have been 21.8%. Okay. So if you get these opportunities to, write a check out of your credit card, know that that is going to cause you higher interest rates. And typically, you'd have to read your terms of service. You're going to start paying interest on that money from the minute that you get that cash. So with purchases, you have a grace period. So the grace period might be 20 days. At the end of the cycle, the billing cycle, then if you pay off that full balance, then you don't have to pay any interest. Okay, so let's look over here. So if you make no additional charges and only pay that minimum $35, it will take Teresa a year and a half to pay off that balance of $523.20. So she doesn't charge anything else and she only pays the $35. It's going to take her 18 months. Okay, so in total, she will have paid $627. So how much interest is that? Well, we would just take the $627, subtract her balance of $523.20. She will pay $103.08 in interest. Okay, but the next line tells us if she just boosts up her payment just a little bit to $49 instead of $35, it's going to take her a lot less time. It's only going to take her a year to pay it, and she's going to save $31. That's a lot of money. Okay, so the best option would be if you just paid the $523.20 and then you don't pay any interest whatsoever. Okay, so let's read this part right here. Okay, if you don't make that minimum payment by the date that your bill is due, you may have to pay $35, and the interest rate, the APR, is going to jump to 29.99%. So if you are late on your payments, that interest rate goes skyrocketing. So if you are going to, not pay the whole thing, at least pay something so you don't, have to pay those late payments. Okay, so if we look down here, this just shows us, she purchased something at $523.20. She made that payment. Again, this tells us our interest rates. So this should give you the information you need to be able to read a credit card statement.